Are you a homeowner looking for a smarter way to manage your finances? Imagine leveraging your home's equity to pay bills or finance significant life events. A home equity line of credit, or HELOC, makes managing your debt easier and more efficient. The Sharpe Mortgage team specializes in refinancing home loans, offering tailored solutions that put your financial goals within reach. Why stress with the burden of high-interest debt when you can simplify and save? Seize the opportunity to steer your financial future in the right direction by contacting the experts at the Sharpe Mortgage team. Start your journey toward financial freedom today by visiting their website at sharpemortgageteam.com. Remember, your home could be the key to a more secure and prosperous tomorrow. The Sharpe Mortgage team, where your financial well-being is their priority.
This is the Triad Podcast Network.
Hey everyone, welcome to another real estate episode here on the Triad Podcast Network. It is our guy Blake Ginther from the Ginther Group, who joins us every month to talk real estate. And Blake, last month, we even mentioned it on the show that Ashley McKenzie-Sharpe, our fantastic supporter from Sharpe Loans, she had expressed an interest in being on the show. And so we knew we were going to try to schedule this, but man, the timing could not be better, right? Because there is some stuff happening in the market and then also with mortgage rates. So this is good timing to have her on the program, is it not?
I think it's great timing. I think it's perfect timing. We've been talking about, off our podcast, we've been talking about bringing Ashley in now for a couple months. And then on our podcast last month, we said we were going to, and then you reached out and said, hey, you think Ashley, and it was, I mean, with what the Fed just announced, and Ashley will tell us all about what that actually means for her world. But with that, and now interest rates becoming pertinent again, because I will say, like, from my perspective, interest rates, it just stopped being a conversation. We really didn't talk much about interest rates. I was so glad that realtors stopped trying to predict it, because it got embarrassing when we would be like, they're coming down, and then they just actually went up for several, But I'll be curious to hear, and super appreciative that Ashley could hop on, because I think consumers are curious, what does this mean? And for the record, I think consumers, if they were going to buy, have already bought or already going to buy, period. But that doesn't mean they're still not like, does that mean my rate will be better?
Yeah.
I mean, a lot of people are budgeting it in now, right?
Yep.
Hey, Ashley, real quick, I gave you a very quick intro, but maybe elaborate a little bit more on. Let's hear your bona fides. Let's hear, because Ashley is tremendous when it comes to this particular topic. So tell folks that haven't got to know you yet, that should get to know you, what you do in your area of expertise.
So Ashley McKenzie-Sharpe, I'm here in the Triad with Highlands Residential Mortgage, and I've been in this area as a lender for over 20 years now. So that's kind of my claim to fame, is that I'm just getting old, and with age comes experience, right? So that's kind of my little tag.
Okay, so explain to me, to Blake, to everybody listening, what has happened this week with interest rates.
Last week, let's go back 1 week. So last week, we heard from the Fed. They came out, they said, look, they changed their verbiage, right? I mean, they said words that were a little more affirmative, so that we really feel like they are going to move the rates down in September when they meet. And Friday, the market reacted in a really positive manner. We saw rates kind of drop quickly into the fives, and then kind of spun backwards this week. So we kind of lost ground Monday, Tuesday. Today, we're kind of teetering. And I think all of that kind of hinges on employment. There's a lot of things that are really inflationary, kind of indicate recession. All of those things impact the market. So we're kind of fighting that talk with what the Fed is coming out and saying. But I do think rates are still lower than they were. They're definitely in that mid to low 6 range now. So it's a great time to go on and get out there and start looking.
I just wanted to say too that we said right before we hit record that I think the consumers, by and large, who were waiting for rates, I think realtors and lenders talked more about rates and had it, from our perspective, it impacted things more. In the last 6, 9 months, I think that the consumers have just gotten accustomed to it, and they're either going to buy or not, right, or sell or not, regardless. So I just think it's going to be an added bonus for those that are in the market coming here now slash the next, probably at least next quarter, because we don't know. I mean, I think everybody thinks that with GDP is going to go down and that therefore rates are going to continue to go down and therefore 25 rates will be better. But I mean, I don't think we know. And Ashley, do you think consumers follow it as closely as realtors and lenders?
No, they don't. I think they get a lot of their news from the actual news, the media, and that they've been off. They've missed it several times now. So if they're getting their news from the media, then we're probably in good shape. It's just not been right. But I'm with you. I think that there's a lot of borrowers who are on the cusp of, like, they're either just in it and they're going to buy something and they're going to refinance later. There are a few people that I think that affordability is, it's really impactful to see those rates come down, because now that increases their buying power by, a good 50 to 100,000 if the rates have shifted 1%. So hopefully we'll get some people off the streets and back out there on the hunt.
I am surprised. You said fives. I am surprised. Weren't you a little surprised? I thought it would go from hovering around 7 to hovering around 6. I didn't anticipate, anything below that. Do you think that fives are really a possibility this fall?
I think fives are a possibility for government. I think you're going to see, like, your FHA, your VA, those types of loans. I think you're going to see in the high fives. I think your conventional loans are still going to remain kind of low sixes, mid sixes. But maybe we might be able. It really depends on the credit score and down payment, type of property. All of those things come into play, and they all kind of combine, and they can get those rates down into the fives, even with conforming.
I hesitate to say this because of what you said about where people source some of their information about what interest rates are going to do. But everything that I've been reading lately seems to project that there's a drop expected in September of interest rates. Is that something that you think you agree with that projection, or what might we see over the next, I don't know, 30 to 45 days?
Yeah, I definitely think that in September we're going to see the Fed drop. The amount I'm not sure of yet. I think that time will tell, and kind of, where the market heads. I actually think we might see 2 cuts this year. So I think we'll see one in September, and I think we'll see another one, just to try to get, the market corrected.
I think it's interesting too, Adam, that a lot of what people are reading, and then when they hear these cuts, that there is some national media discussion again, and it kind of chilled out for a while around the housing market. Whatever negative word you want to use, right? I don't think I've read crash quite that dramatic, but I have read, fall, recession, whatever negative word you want to use around the housing market. And I do think it's interesting because the data I have been bad about doing my market updates because it's like the data is the same, right? There's really not anything new. So I feel like, what am I going to say? I'm just going to say the same old thing. And our inventory has remained just totally flat. And that's with a lot less buyers, right? So because the interest rates did remove a lot of buyers, and because I think too many buyers bought when, prior, right, which is part of the problem in the inventory issue. So I think it is, I guess, very location specific, but we are seeing, like, this week I had an agent say the folks loved one of our new construction houses, not far from where Ashley lives in Davie, and the agent said the consumer wanted to make a ridiculously low offer because they thought the housing market was crashing, and the agent was like, what? Everything's sold in this neighborhood. There's like one house left. builder just is finishing it. What do you do? What are we talking about here? And that's just their perception. And when he drilled in, it was the media, right? They made him think that he could get a great deal because the housing market was crashing.
Encouraging people to rent. I mean, when, why? When has it ever been better to actually rent than to own a home that would appreciate? I mean, there's a lot of news that's not quite in line with the true market and reality.
At least with ours, maybe others.
Right. Maybe another market.
Ashley, can you share some data along those lines? Because I've seen you post on social media about just the long-term wealth and impact of owning a home versus renting. And Blake and I have had this conversation many times on this show about the difference in, you're building equity, you're building wealth, you're investing in an asset that traditionally will continue to grow in value, and with renting, you're always going to have 0% equity. So Ashley, what can you share with us about just some of the numbers and context behind why it just makes more sense for people to look into owning a home versus continuing to rent?
I think even if you just look at the last 5 years and, people who purchased a home and then the home almost doubled in value. I mean, that's huge. And there's tax benefits. There's a lot of good, positive reasons to actually owning a home. Yes, there's upkeep. Yes, there's expenses and things that you have to do to own a home. But in reality, all of the equity that you're going to grow. I mean, even what's the minimum percentage that we see usually in equity per year? What is it, 3?
Historically, it's 4, right? Locally,
4, okay.
Locally, we were a little more conservative before COVID, right? We were like 2-3% consistently. And then COVID hit, and we were double digits all of a sudden.
I mean, that's a big number. I mean, if you buy a home and you stay in it for 10 years, that's a good little bucket you can pull from to buy another house, invest in a business, buy, additional real estate. So, I mean, I think that people are really missing the boat if they're going the rent route and really avoiding buying homes out of fear.
Adam, I was going to say too that a mentor of mine, when I met with him a few years ago, kind of like actually it was peak COVID, and most of us who have bought investment properties had put ourselves on the sidelines because the market was just insane. And he was like, "Okay, so you bought the house for $200,000. Your rent literally covers all your expenses, right? You make $1,500 in rent, and it covers your mortgage, taxes, and insurance. You literally broke even. And then 10 years from now, you sold that house for $200,000. So you literally made no money, right? Which, by the way, hasn't happened in like history, but let's just play this out." He said, but let's just imagine it did. What would be your rate of return on that investment property? And there were like 7 pretty successful realtors in there who were like, really should know that. And we're like, 0, sounds like 0. And he was like 8.6. And we went, wait, what? And ultimately, because you had a tenant buy down your mortgage, and you did make money on that through them paying off your mortgage. And I'm not turning the corner from us saying, but that is a good point of why it always makes sense if you can. Now if you can't, obviously you got to do what you got to do. And the rental market has softened even more than I think the sales market. So good news is for those that can't afford to buy, I think you're going to have more options to rent.
Life is full of celebrations, birthdays, holidays, life milestones, and so much more. And who has been helping generations of families celebrate these events? Our friends at Dewey's Bakery. And even if you aren't planning for something in the near future, you don't have to wait to enjoy something savory and delicious from Dewey's. Maybe you just need something to get you through your Mondays. Drop by every Monday for a free Cake Square Day. No purchase necessary. Just come celebrate the start of a new week. So, if you're hearing this ad on a Monday and you're in your car, reset that GPS and get to one of their 3 Triad locations immediately in Winston-Salem at Thruway and Renolda Manor, plus one in Greensboro at Friendly Shopping Center. And any day of the week, you can find the perfect item with fast and easy ordering options at local.deweys.com. Plus, Dewey's does so much to help celebrate our community. To date, they've given back over $4 million to local schools, churches, and other nonprofits. Your next celebration isn't complete without something special from Dewey's Bakery. Dewey's. Celebrate every day.
You know, Blake, the conversation that we were having last month when Ashley's name first came up was a trend that I'd been reading about where people were going in together on purchasing a home.
Yeah.
Not spouses, but like a buddy, a friend, whatever, that you might say, hey, let's go be roommates and rent an apartment together. But instead, they're going in together on a home loan and purchasing a property. And we wanted to specifically ask Ashley about that, if that's something that she sees. Is there anything that people might have to do differently in the process if you're essentially co-signing on a loan with somebody to whom you're not related, that kind of thing?
Have you seen that, Ashley? That sounds like a genius idea.
It really does. I mean, I would take 4 people, get them all on a loan, and then, work it backwards. It is really a good idea, right? You can do this with family members. You can do this with friends. And we are seeing more and more people do this because of the creative financing angles that you can now exercise. So we have loans for people who are self-employed where we can actually generate income based on their bank statements and not look at actual tax returns anymore. And then we have a great loan option for investors where you can go in, buy a home, put down 20, 25%, and take a rate that's, it's pretty, 30-year fixed in the 7s. Right now, probably will go down in the 6s. And we literally use the rental income that the appraiser states on the appraisal, and we use that to offset the mortgage payment. And it can almost even be, we have a product where it can almost be like a negative AM situation, and we can still use that and not document any income. All we're documenting now is rental income, offsets mortgage payment, and you have the assets and the credit to buy. You can put 4 people on a loan and just document their assets and their credit and roll, and you all could all share assets. So it's a great option. Makes things a lot easier as far as paper trail.
Blake, did you learn anything new with that? I did.
Yeah, and I do think, I don't think that's happening enough. I just thought of a friend who lives up north, and he absolutely should be buying a house with his sister. He's not. They're renting, and I've talked to him about this before, but I think that his response was, "Well, I don't think I'm going to qualify for what I want." But I'm like, well, you probably do with your sister, and if you're living with her now, what are you going? Why not buy?
You don't have to do these DSCR, these creative loans. We do have options where if you have W-2 solid income, you have 3.5% to put down. You can buy a home with a friend or family member and purchase that as a primary residence. And you can both occupy the dwelling, or one of you can occupy the dwelling and it be your primary residence, and have a co-signer on that loan. So there's ways to make this work for everyone, not just the investor.
Yeah, I definitely did. I hope that people listening, because I do think that consumers who've already purchased and we talked about it in the beginning, right? Rates won't matter for a lot of folks, but I do think it's more than just rates as to why there might be people on the sidelines now, which is ability to buy.
I think we're missing the savings piece. We definitely are. That's something that a lot of people were encountering, and I'm not sure if we even want to go here, but with the 17th, that's going to start impacting our buyers. And hopefully we'll have some options and solutions around that, not just financing it into the loan.
Yeah. And Adam, she's referencing, right, the real estate changes, right? The laws around agency And if buyers do indeed have to start paying, for to be, compensating for them to have agents, right? For there to be a buyer's agent. So far, right, in the beginning, we haven't noticed as much functional changes so far. And we'll see. I think, we talked about it in the last few, I don't know, 2 podcasts ago. We'll see it first in the cities, right? Do they start removing compensation for buyers agents, and therefore buyers end up having to pay? Now, Ashley and I've talked about it offline, and I think it's the biggest impact will be if that happens, will be on government loans. Conventional, I think there's ways to make it work. But government loans, that could be a real problem. And that would be who needs agents the most, right? First timers or government, purchasers typically will want agency.
Hope we find a way around it.
That's going to be discovered hopefully in the next month, honestly, right?
Yeah. We will know soon.
One thing that never seems to change as the years change and all the different interest rates and market trends and things like that is the pre-approval for a loan and how that helps in the process. So we've got somebody on the agency side, and now we've got somebody on the loan side with the two of you on the same show. And I'd love to hear each of you speak from your own experience with buyers, the importance and why it helps to make sure that you get that part done before you start getting serious about your search.
I mean, I think it's huge. It impacts the entire conversation, because if you know what you can afford and you can actually share that budget with your agent, then they can guide you in your home search. So it takes a lot of that, wasted time just, looking at everything, and really hones in on what do you want? What do you want your monthly payment to be? And what can you afford? And it also, ensures that you're not wasting your time. I mean, maybe you do need to step back and wait 60 days, work on credit, work on savings. I mean, maybe that's the reality, but at least it's 60 days and not a no, right? I think that more than ever with the new, commission changes and things like that, I think it's going to be really vital to who you work with and directing that business to the right person, because I think that the conversations are going to change with some of these online lenders. And I think that deals could kind of fall apart based on that. I mean, we're going to need to understand the commission piece. We're going to need to make sure that assets have been verified. Credit has been pulled. Do we really know that this borrower qualifies? People are, especially in North Carolina, people put down a good chunk of money and that in deposits that they can't get back. And I mean, that I think people forget that we're a little bit different in this state that with due diligence.
And I'll just throw in there too that I think we're going to be moving more towards, I think people hear rates dropping and they go, oh, cool, they want more buyers. I mean, not necessarily. That's not necessarily why it's happening. And I also feel like people who are doomsday about our market, they're not deregulating, right? There's still going to, it's not going to be easier to get loans. And I think that if you shop a pre-approval with somebody online or somebody who doesn't ask enough questions, all that does is delay the pain, right? And so getting with somebody who knows what to look for, knows how to get you the right product, right? And with the right amount of pre-approval. Because I do think consumers a lot of times just go, well, who's going to give me the most? Who's going to say I'm approved for the most? And all that does is delay the pain, because if you call 3 lenders and you get several different quotes and pre-approvals, and people go, well, that will kill my credit. I mean, there can be soft pulls, right? It's not gonna, but regardless, it's if you go to somebody and you're just looking for a high pre-approval, you're just gonna be disappointed, because when push comes to shove, that might not be your approval. And then you might have fallen in love with the product that you shouldn't have.
And then you put down a deposit on the house, you go under contract, and that money,
Is
you could
gone.
lose it.
Yeah,
It's
no,
gone.
it's gone.
Yeah.
Not good, but will, right? You will lose it. And
Will
so,
lose it.
and to get a home, if we're talking about a home, north of our average price now, which is 325 here locally, if you're north of that, then it's several thousand dollars, several thousand dollars.
A lot of money. It's worth it to take your time, talk to the right people, and make sure that you are approved fully.
What do we typically see in an election year? I was having this conversation more about stock markets, and there tends to be more volatility in stock markets in an election year just because there's uncertainty. It's not necessarily about which political party comes to the White House or what. It's just because the market doesn't like uncertainty. So specifically in your areas of expertise, what do we normally see in the months leading up to a general election?
I think we're seeing it. We're all over the place. I mean, especially this election, right? I mean, there's a lot going on. But I mean, the market has been just up and down and up and down. And I think that what people are doing right now is they're kind of just gambling on what's going to happen, how is this all going to play out, and that's kind of impacting the market. They're kind of baking information on into the market and into their evaluations. And then I think, next year we will see it start to steady out. But right now there's just a lot going on. I mean, unemployment is a real thing. So, affordability, there's a lot of things with housing and with the interest rates, that we're just talking about rates. But there's a lot of other things that are going on right now that are impacting that rate number.
Yeah. I don't have much different to add, right? I think it's going to be a bit of a up and down, and I think that I mean, we are fortunate that we live in a transient location where there are people who have to leave, come and go for jobs, for the medical industry, for the banking industry, for all the colleges that we have here locally. So there's enough transient spots that folks are going to be coming and going regardless, that I think it will have some continuity from a real estate perspective. But I do think that you will see some folks think that the sky is falling, so they sell. And some folks think that the sky is falling, so they batten the hatches.
It's time to get serious about your financial future. It's never too early, but it could be too late to get started. And that's oftentimes the hardest part, getting started. How much do I save? Where do I invest? Do I save for college or retirement? How much for each? And who do I talk to about it all? Okay, we'll keep things simple for now and help you answer the last one. We recommend you begin with a local financial advisor, and that's Jennifer Johnson of Three Magnolias Financial Advisors. She'll sit down with you for a complimentary introductory consultation and go over all of your questions. Get started on the path to achieving your financial goals. Visit threemagnoliasfinancialadvisors.com or call 336-701-1600. Get comfortable with your financial future. Three Magnolias Financial Advisors. Retirement, financial planning, and investments. Securities offered through Private Client Services. Member FINRA SIPC. Investment advisory services offered through Three Magnolias Financial Advisors. Three Magnolias Financial Advisors and Private Client Services are not affiliated. Private Client Services is under separate ownership from any other named entity. What should people be doing to try to keep their finger on the pulse of this? I don't know, it's tough to predict any of this, right? But if someone's out there saying, I want to strike while the iron's hot in terms of getting the lowest possible interest rate, what's the best way for them to keep their finger on the pulse of that?
Work with a really good professional, mortgage lender and agent. I mean, because combined, I know I communicate with my clients about the market changes, what's happening. And I still feel like it's always better just to do it now and not wait, because, if you buy now while the market's not quite as hot, maybe, right? Then maybe you get a decent deal, you get some seller concessions, things like that, and you refinance in 12 months. And then you don't have to fight off the crowds to find the home and go under contract, but you will get to take advantage of that low interest rate and that lower payment, and be in a, in a better space. That's what I would recommend.
I mean, historically, it is a better time to buy locally in the fall, historically. And I think that will probably ring true this fall. We still don't have a high inventory. So technically, the data still says we're in a seller's market, but we have more homes for sale now than we did, basically in the springtime market. And I believe that will be true next year. I mean, there will be less inventory and more buyers most likely next spring, even if we have a slipping economy, which I think most people think is happening, right? That by next spring, the economy signals will not be pointing up, and therefore people go, oh, well, then the housing market will follow suit. Well, honestly, historically, that's not true, right? That isn't true, and it also depends on where the housing market was when we slide into a recession, and with our low inventory, I don't think it's going to match. If we have a recession, I don't believe the housing market, because what will happen is there will be less people selling.
And so inventory will just continue to get lower.
Yeah, right. It won't fix. It won't fix. And worse, builders, and this is already starting to happen. Builders are wanting to build more than banks are allowing them to. Builders funding is slowing down. And that's just banks being conservative. And you know what? You understand it, except as an agent, you're like, okay, but they're willing to build a product that the market doesn't have enough of. Give them a dang loan. But a lot of lending institutions and our local banks have pulled back on the amount of spec loans they're going to give a builder. And I mean, on one hand, you understand it. On the other hand, well, that's just going to compound the inventory challenge.
All right, I have one more question, but there may be other things we want to get into. If somebody has owned a home for let's say the last 5 years, and they've experienced, Blake, those double-digit increases in equity or value of their home, so they've got a lot of equity built up. Do each of you recommend that anybody in that situation should have a home equity line or a cash out refi, or what should they do with that equity right now, even if they don't plan on using it?
I think a lot of folks have heard my answer to this, so I'll let Ashley go first. What do you think, Ashley?
100%. I would use it all day long. I would always have an equity line. I mean, period. If you have 50,000 in equity, have an equity line, right? If you have 20,000, have an equity line. It's there. It's a safety net. That's what you should have it. But I would be using my equity in my home to buy other property. I would invest. I mean, there's so many avenues that you could take that money and spin it off and make more money. I mean, most of us are sitting at interest rates in the twos. And even when you do an equity line, it's not going to be in the twos, but you can make more money than you're paying in interest. And so, yes, all day long, cash out refinance. I think one thing that has come to light in the last several months is that a lot of consumers have a lot of debt right now. Consumer debt is at an all-time high. So if consumers are sitting there in a home with the rates in the twos or threes, and they have debt that they're paying on that's at 20%, when we sit down and we do the math, it makes a lot of sense to go in, cash out refi. Yes, you let go of your 2% interest rate, but you're going to consolidate all of your debt into one loan, and you're overall out of pocket, and your net interest rate is going to be much lower, and you're going to be in a situation where it's manageable now. You can actually take your debt, you make one payment, it's something that's affordable, and then you can really get a handle on your finances. I think that's something that a lot of people are kind of sitting back just because they're so hung up on the interest rate, and they're forgetting that they're sitting on a pot of gold, and they're not willing to tap into that, so they're just going to sit there and struggle. So hopefully more people will actually start to utilize the debt and call for cash out refinances and open up their home equity lines.
Yeah, I'll just basically say one additional thing, which is if you are in a financially challenging spot, cashing out refinancing might be the answer. I think a lot of people think the other way around. They think equity line, quick cash, and take it and pay off. But that's just compounding most likely a problem, right? So I think that cashing out refinancing, even if you have a 2.5% interest rate and you have to cash out all the way up to currently a 7, we'll say, if you have, steady income, right? If you can still qualify, right, to do it, then that's exactly when you should cash out refinance and consolidate debt and start to get on a better financial plan, right? And that does raise your monthly, but it also, if you have credit card debt or you have bad debt, right there, and when that's what I will tell you, Adam, is through our renovation program, we are getting indoors with sellers who are finding themselves in less than desirable spots, and oftentimes just saying, "I'm in trouble, just buy my house." And that's not what we're there for, right? We're there to provide them all our options. And after going through them all, sometimes, actually once last month, that's what we had to do, right? And after providing all of the options, and they could have renovated their home, but they put themselves in a tricky spot financially, and they didn't have steady anymore. So cashing out refinancing wasn't the right place. Selling, taking the equity, and then starting anew had to be. But I do think that, to Ashley's point, everybody should open an equity line. If you are conservative by nature and you don't think you'll use it, you're exactly who should open an equity line.
Yeah. That's the point, is that you open an equity line when you don't need it, because when you do need it, you may not qualify. And that's the secret to it.
That makes a lot of sense. So I think that's a great place to punctuate the conversation. So what I'll do here is I'll give each of you a chance to, again, remind folks how they can contact you. Yeah, I mean, the home equity line, if you're somebody who's owned your home through the craziness of what post-COVID was, chances are you've got a lot of equity in your home, and you should look at some options with that. And then if after you tell folks how to reach you, if there's any other final words you'd like to offer our audience, we'll give you the floors for that as well. So Blake, if you want to go ahead and start us off, and we'll actually have the final word here.
Cool. Thanks, man. Thanks for doing this. So yeah, you can find me on the interwebs at theginthergroup.com, theginthergroup.com, or 336-283-8689, 283-8689. And Ashley, I appreciate you hopping on and talking about what I think is going to be a lot of people's topic of choice over the next, month or so.
Thanks for reaching out. You guys can reach me at the sharpeloans.com or at 336-575-9448. Would love to help anyone who has questions, help about, with credit, debt consolidation, anything like that. We're here.
Great. Thank you both so much. This was a fascinating conversation, always informative. They are two great experts in their field coming together for a wonderful episode today. So Blake, Ashley, thank you all so much.
Thanks, Adam.
Hey, thanks for listening to this episode on the Triad Podcast Network. Our mission is simple: provide information, advice, and stories about the people and places that make the North Carolina Triad such a great place to be. You can find us by searching Triad Podcast Network on Apple Podcasts, Spotify, pretty much wherever you like to listen. If you like what you heard and want to support the show and those that contribute, we would truly appreciate a rating and review on your favorite podcast app. It helps spread the word along, as do your shares on social media. You can find us on Facebook, Twitter, Instagram at Triad Podcast. To get in touch with us, simply email info@triadpodcast.com. Thanks for listening.
This is the Triad Podcast Network.